wanted to give a talk on initial thoughts on how the hell we recover economically from this. Excuse the salty language. I could have made it a little bit saltier, but I thought it'd be a little bit more professional. But this has really been crazy. I'm looking at economic job numbers. The scuttlebutt with my friends is that they actually think that unemployment could be honestly between 15 to 25% right now, and that we will actually be hitting 50 to 25% unemployment in the United States, and that's pretty unprecedented. These are depression level kind of numbers, and I've been thinking a lot about how do we actually recover from this. Can FinTech actually lead us out of the recovery? I believe it can. I think we're going to actually need to innovate to actually be able to start capitalizing companies around the globe, and this is something that I've been spending a lot of time on. Let me see if I can get the next slide. First of all, hackers in our name. In the FinTech community, I always have to be careful to actually say, you know what, hacker in Silicon Valley is nice hack dude. Think of Steve Wozniak would call himself a hacker. It's a person with deep technical understanding who really disrupts the status quo. These are the types of people that actually come to our communities, not necessarily a security hacker who cracks people's security information. But as I said, really, Hackers and Founders started off as this meetup community in a bar. These meetups have really gone globally. They've gone viral globally in the last economic downturn. We're actually starting to see a lot of underemployed entrepreneurs start to think about what is my next company. That's what happened in 2008, 2009. I started having hundreds of people show up at these events and bars saying, hey, Jonathan, how do you raise money in Silicon Valley? What is Silicon Valley about? How does this work? Hey, this was a great event. Can I build my own community back home? And really, it's this network, these incredibly powerful networks of tech entrepreneurs, FinTech entrepreneurs, that I think are very high velocity business networks. It's starting about 3 or 4 years into Hackers and Founders. It would be pretty often that I would be reading through the New York Times and I would see, friends of mine show up in Stories and Forbes and Fortune, and I had bought them a pint, a couple of years earlier. And so these high velocity business networks, I think, are incredibly important. And this is why I love what you guys are doing with FinTech community or FinTech Connector, and why I love being a part of it. I started looking and seeing about a lot of problems that our community was actually having in terms of capital raising. Let me fast forward the slide. There we go. And one of the things that we actually started seeing was that it was really very hard, very difficult to actually raise capital outside of Silicon Valley. We started a business helping companies to do soft landings. We started making a couple of nominal investments out of our balance sheets. We created 3 funds in the United States. Pre-coronavirus, they were up 1.7 to 2.7x. We started a program in Mexico for companies scaling across the Spanish-speaking world. We're having some companies that are going to be falling over, another couple of companies that are actually, growing exponentially right now. It's a very kind of weird black swan event, and so across the portfolio, we're actually seeing that. We have actually done a lot of work with corporates. I served on an SEC advisory committee on capital formation. Looking at, and I'll talk about that in a little bit. We have a partnership with Vodafone Innovation. Microsoft, we helped them on the developer evangelism strategy a number of years ago. Dell, I've been asked by the Department of Commerce to actually advise them on AI strategy. And in the last couple of years, we've been working with the London Stock Exchange on developing pathways to liquidity for startups in emerging markets, specifically building bridges between Latin America and the London Stock Exchange. And I'll talk a little bit more about that as we go along. But it's been a weird career, from being a nurse to a software engineer to really kind of obsessing about the problems of startups getting capital in emerging markets. And it was really that actually, when the Jobs Act came around, we submitted about 80 pages of comments to the SEC on the Jobs Act, because my initial vision was that our communities would be able to fund each other and invest in each other's companies. and it wasn't really working terribly well. We submitted a bunch of comments to the SEC. We were quoted about 50 times in the SEC in the Jobs Act regs. I met Commissioner Stein. She actually asked me to become an advisor to the SEC, so I joined an advisory committee on capital formation to really do a deep dive on why so much venture capital gets invested in Silicon Valley, in New York, and why the middle of the country really struggles to raise capital. And as a corollary, you see a lot of capital that's actually invested in a couple of little finance hubs around the globe. And vast parts of the globe are actually capital starved. And I think that what we actually discovered in doing that study at the SEC is key to the challenges we're going to have in this economic recovery. And I wanted to talk a little bit about that. And basically what we found at the SEC was that venture capital and investment capital for a startup is really restricted to exit hubs. About 2/3 to 3/4 of the world's venture capital gets invested in Silicon Valley. A good rest of the chunk of that gets invested on the East Coast, New York, Boston. After that, you're looking at London. And why is that? When you do the deep dive analysis, it really boils down to it's 85% of all of the world's tech M&A happens in Silicon Valley. And our entire venture model is really built on this invest to flip business model. What do I mean by that? An angel investor invests in a company, they buy stock into a company. They can't get their money out unless a company IPOs or unless that company gets acquired by somebody else. And 85% of the world's tech M&A happens in Silicon Valley. So guess what happens? Investment gets concentrated, gets bulked up into these exit hubs. And as we're actually thinking about an economic recovery, that's going to be a very, very large problem. How does a small business in Des Moines, in Atlanta, in Denver, in Sao Paulo, in Buenos Aires, in Dubai, in Turkey, how do these emerging startup hubs, how do we actually get capital into these companies if we can't get the capital back out? And right now, before coronavirus, venture capital in Silicon Valley has about $1 trillion waiting for liquidity. If you add up venture capital over the last 10 years, how much of that market value is just waiting to IPO? You're looking at about $1 trillion in illiquid assets right now. And LPs and institutional investors are sitting there saying, when am I going to get my money back out? And this is also what we found in all of these emerging startup hubs around the globe. We started doing a lot of investor education in our Mexico program, trying to educate high net worth individuals. This is how you invest in a startup in your own ecosystem. And the pushback that we would get from these family offices was, look, I love the idea of investing in the company and my own economy. I love the idea of growing my own economy. But here's the issue. If I like, Fabian's startup, I put $100,000 into Fabian's startup. How do I get it back out? And initially our response was, well, in Silicon Valley, we know how to do this. You invest in a portfolio of 25 companies, and one out of those 25 companies will get acquired by Google. And the family office would push back and say, Jonathan, I don't believe that Google's going to acquire a startup in Mexico. And I was like, crap, you're right. Well, then one out of these 25 companies would actually have an IPO. And he's like, Jonathan, the capital markets and the path to liquidity, path to IPO for Mexico, how many companies in Mexico have IPO'd on the NASDAQ and New York Stock Exchange? You got to have $100 million in revenue before they'll actually be even willing to talk to you. And I was like, holy crap, you're right. It's really irrational for you to invest in startups in your own ecosystem. You're really hoping that this liquidity problem gets solved. And so this is why I was particularly interested when the London Stock Exchange actually reached out to us a couple of years ago. And we have actually since talked to about 15 stock exchanges around the world, various Euronexts, Singapore, Hong Kong, Tokyo, Mexico, Colombia, you name it. We've talked with a bunch of stock exchanges, and we've started talking about how do we actually develop more liquidity. For investors, for capital to flow into economies, you have to have a way for it to flow back out. You have to have investors. You got to give a way for them to actually be able to make money. And I believe, and I don't have any skin in this game, but after all of these conversations, I believe that the London AIM is probably the best and one of the few functional small cap stock markets out there. We actually have a number of companies that we are lining up from Latin America to actually IPO on the London AIM. I am increasingly starting to think of London AIM as an IPO target for companies in Middle America that are actually interested in accessing capital. Mind you, the capital markets in the UK are going to have to recover. I think it's going to be another 6 to 12 months before they can actually do that. But the target, if you actually have $5 to $10 million a year in revenue, and if you're actually growing at about a 30 to 50% clip year over year, which is a fast growing SME, you can actually successfully do an IPO on the London AIM. It is not a panacea, there's issues, but I believe after all of our research that this is the most functional small cap IPO market. Another thing that we actually looked for and that was really interesting is London's publicly traded venture capital program. So they actually have a program where you can take a venture fund and IPO the fund itself. And this is where I think the future of our recovery actually is. Why is that? In a traditional venture model, it really is a invest to flip. You invest in a company, you have to have an exit, you have to have an IPO for the LPs, for the initial investors in that fund to actually see a return. And venture as an asset class actually struggles. It usually struggles to outperform a Russell 2000 index on a year-to-year basis. It usually underperforms about 2% per year. I think that's fee related. We can talk about that later, maybe some beer involved and have that conversation. What's very intriguing to me is that the idea of a publicly traded venture fund, and these are closed-end funds whose purpose is essentially to bring liquidity to illiquid assets. You take a venture capital fund, you invest in a bunch of high-growing, fast-growing startups, you IPO the fund itself, and now as a fund manager, I am judged not on how many startups I can flip to Google for 10 years. I am judged on the growth of my NAV. What does that mean? I get judged on the growth of the value of companies in my portfolio. And, typically you would value the growth of a company. The easiest metric that I can actually find to do that is revenue growth and a clear line of sight to profitability. So our plan is for Hack Fund, for our fifth fund, we're doing our first close privately. And then after that, we will go ahead and do an IPO for our venture fund once capital markets start to open up in London. And the idea is that we would invest in companies that are targeting at least 30 to 50% revenue growth year over year, clear line of sight to profitability. We have a third party value our portfolio on a quarterly basis, and then that gets reported to the public markets. Now, what I got to do is I got to be sure that my companies are growing in value on a quarterly basis, right? I don't want my fund to trade below NAV. I want my NAV to be growing aggressively. And you know what? This isn't a panacea, but how do you actually invest in a company in Atlanta, Georgia, in Des Moines, in Chicago? How do we actually start replacing all of these jobs? I believe that an answer to that is going to have to be publicly traded venture funds. Instead of an invest to flip model, I really think that we actually need to have an invest to grow model. We are going to need to create, small businesses right now are going to get decimated. Restaurants, retail, a lot of small businesses are just not going to make it through this recovery. I'm telling my portfolio, just my personal experience as a nurse, I don't think that we're going to see a significant resuming of business until we actually can start to vaccinate 3 to 4 billion people against coronavirus. That's going to take a while. at least 18 months. And if it's going to be 18 months, that will be a world record for a vaccination creation. So I'm looking at a very kind of long-term secular downtrend in terms of this. I'm also thinking of how do we capitalize the next generation of companies that actually grows. I believe that publicly traded venture capital funds have to be part of this mix. And this is where I'm actually placing my eggs. Why London as opposed to the United States? That's actually interesting. It actually costs about 15% of the cost to do an IPO in London as it does in the United States. To do this in the US would cost me $3 to $5 million in terms of SEC compliance, accounting, reporting. It's about 1,000 pages of documentation that you would have to generate to IPO in the United States. And if your lawyer's charging you, $1,000 to $2,000 an hour, that adds up pretty quickly. And you're still looking at about $2 to $3 million a year in maintenance costs for an IPO in the United States. The cost to actually do this in London are about 15 to 20% of that. And so we can also have a discussion about comparative and regulatory frameworks between the UK and the United States. I really think that the United States actually needs to start taking a lesson from what's happened in the UK. But that's really what we're doing. I think that generating liquidity, earlier liquidity, a pathway to earlier IPOs, changing a bit of the regulatory framework in the United States. I believe that episodic auction for startups, listing their stock instead of having 24/7 trading and letting hedge funds pummel small cap and micro cap stocks. I think that eventually what we're going to have is a startup to be able to actually auction their stock every 3 months, every 6 months, to be able to generate liquidity for their investors, as well as to be able to actually raise money in public capital markets. Again, these are all kind of FinTech solutions, not necessarily new. These FinTech solutions happened a couple hundred years ago when the Amsterdam, New York Stock Exchanges first kind of started. But that's kind of my talk. I will pause here. I will answer questions. And Angel, any questions from the community?
Great. Yeah, no, we have 6 questions. I don't know if we're going to be able to get through all of them just in the interest of time, and we want to make through it. But I don't know if you have to leave. I know you do have to leave a little bit at 12:30, but these are some questions that we could also follow up. But I'm going to open it up. The first question that we have is, Scott, I'm going to open up your mic. You have a question here. If you would like to speak, go right ahead. I think it's always better to have engagement. So, Scott, are you there? If I don't hear from Scott, I'll ask the question. Scott, S-C-O-T, you had a question.
Can you hear me now?
Yes.
Yeah, I just wanted to find out what your thoughts are on the pre-IPO secondary market generally, and do you think in today's current environment will companies and employees of privately held companies look to get more liquidity for their shares now?
That's actually really interesting. I'm friends with one of the only secondary funds in town in Silicon Valley. I should actually talk to him, and I can circle back around with you in terms of what the market for that is. My guess is that a lot of employees in the next 12 to 24 months probably aren't going to be looking to cash out because they know that they're going to be having to sell at a really steep discount. If you as an employee of an early pre-IPO company actually sell your stock, you're usually looking at a 40 to 50% discount to NAV. When you're actually doing that, if you look at shares post, that sort of stuff, that tends to be going price. And so I suspect that Silicon Valley, if you're currently employed, you're going to want to be holding on to that. If you're currently unemployed, and if you actually bought a house in Silicon Valley, you might be actually looking at cashing out a little bit of that. But again, the challenge on a macro level, the challenge with that is that it's probably only a couple of dozen companies where employees of those companies, early shareholders of those companies, have the option for liquidity. I really think that we need to develop more liquidity in these markets, and I think we need more pathways to liquidity in these markets long term. But I hope that answers your question.
Yes, thank you very much. I'd love to help you if at some point if liquidity is an issue for people that you're connected with. So maybe we should connect outside of this arena.
Absolutely. Feel free to connect with me on LinkedIn. The image on the screen is my QR code for my LinkedIn. And feel free to, or Jonathan Nelson at LinkedIn. I'm very active there.
Thanks, Jonathan.
Thank you, Scott. Next question. Dario, would you like to answer that live? Let me open up your mic. Dario, give me 1 second. Let me get you going. Dario?
Yeah, can you hear me?
Yes.
Okay, just a question, Jonathan. Thank you very much for your presentation. Is there any attempt to link the different startups to a common business model? All startups are looking for money. There is difficulties, I think, around the globe. Is there any attempt to link the different startups for a common business model?
Can you double click on that, link business to a common business model?
Sorry, who's that question for? Is that for Dario?
Yeah.
Dario?
Yes, again, Jonathan, sorry. Can you repeat it, Jonathan?
Yeah, you said if companies can you explain the question a little bit again? I was a little unclear on that. I apologize.
Yeah, so maybe I was not understanding you correctly, but it seems to be that the financial for startups are getting difficult, right?
Mm-hmm.
Okay, so my question to you, instead of having all these silos, all these startups all around looking for money, to try to connect all these different startups that maybe they have a different, let's say, value proposition that can be combined to one.
So the idea would be to actually aggregate a bunch of startups who are looking for capital into kind of one vehicle. Is that
exactly,
kind of
exactly? You know, my experience is that a lot of startups, they're just working on splendid isolation, and they are not connecting to a bigger, let's say, network.
Yeah, and so ideally you would have a fund, or the fund would be the type of vehicle where you could actually do that. What we have done in our previous vehicles is that the startups themselves would actually become part owners of the fund, and we actually called it our Founders Cooperative. And so the founders were actually able to diversify some of their own personal equity into a pool of equity of the other startups that we actually worked with. And so, yes, I believe that there should be, so that founders can diversify their own personal time investments, be able to diversify like that, as well as I'm a firm believer in you have to diversify whenever it comes to startups. You need to have a diversification strategy of 25, 50, even more if possible, if you're going to actually start to capture kind of those outsized black swan sort of returns that are kind of typical of startup investment. So I would completely agree. We really need to develop more of that.
Thank you, Jonathan.
Just in the interest of time, we have one more. We have more questions, and what I'm going to do, I'm going to release some of these to you, Jonathan. Maybe you could answer them as you
Absolutely.
hear along. But I'm going to have one more live question, and then we got to pretty much finish in about 4 minutes. So it has to be a quick one. All right.
Yep.
Dario, thank you very much for that. Next question is going to go to Diane. Diane Imus, are you there? Diane?
Yep. Do you guys hear me?
Yeah, we could hear you.
Awesome. All right. So my question is, I think you mentioned about the funds that you're kind of developing. So which companies that you have invested in are growing in this time period? And what types of fintechs are you seeing being the most successful coming out of this pandemic? And I guess moving forward, because we're going to have to start thinking differently and start changing our, methodologies, like what types of fintechs do you think will see the most success rate moving forward and achieving those NAV kind of calculations that you mentioned earlier?
And so the types of companies that I see are just getting devastated are travel industry, B2C startups, Media startups are doing quite well right now. Any kind of travel industry startups in my portfolio are really taking a hit on the chin, obviously.
Yep.
Where I'm seeing a huge boom is any kind of B2B digital workspace kind of stuff, any kind of business collaboration. You look at the numbers for like Zoom and Microsoft Teams, you know, they're adding tens of millions of subscribers a month, if not a week. You know, at $20 a pop, that adds up to billions of dollars in new revenue. The companies in my portfolio that are doing really, really well are the ones that are actually doing B2B kind of online working. I'm having conversations with a large number of corporates these days, senior executives at corporates. A lot of them had really been thinking about, you know, digital first. Now I'm starting to hear, holy crap, this has got to be digital only. We're not going to be able to meet face to face and sign a document or trade or do business. And so any kind of digital only business is actually going to be essential. And that actually kind of flows into the types of fintechs that we're actually interested in and that we're actually looking at. Is we're looking at, you know, B2B, neobanks. We're doing a lot of work on fintech and emerging markets. Latin America is a huge market for us. You only have 40% banking penetration. You know, how do you provide low-cost banking services with maybe a blockchain back end for these emerging markets where you can actually manage to bank people who only make, you know, $1,000 a month? I think, you know, if you can solve those questions, you now have billions of potential customers. And I don't think that those are problems that traditional US and Western-based banks are actually going to solve. So financial services and emerging markets is a big focus for us. I think there's going to be a massive need for those in the next couple of years.
Thank you.
Great. So thank you very much, Dan, for that question. Jonathan, thank you very much for your time here. There are more questions. I will summarize them and either try to send it through here if you could try to answer them. I don't know if you could see. Can you see the questions that are coming through, Jonathan?
I can. And for those people who have questions, feel free to connect with me on LinkedIn. Post a question in there, and we'll go back and forth via LinkedIn. I'm very open to that sort of stuff.